I think the markets have really underestimated how much is needed. What we're missing right now is some guidance that says how much is going to be enough. Because Powell has clearly said where we are, where we were telling you we're going is not enough. And I think the one thing that Steve and other people haven't mentioned is the guidance that the Federal Reserve report itself gave us. It said that given the kind of policy rules that people have been using to assess different types of policies, we need rates somewhere on the order of 6.5%, 7% to get enough of a slowdown in the economy to get us back to 2% inflation. Those numbers are not even on the table right now. And I think the message is yet to come. And we might actually see if the disinflation story disappears on us and the economy actually is hotter than we thought, we may be seeing 6 and 7% numbers between now and the middle of the year.
Yeah, Steve and I both thought we were just talking to Professor Taylor about this not a couple of days ago. I think he was at 6%, Bill, but either way, it seems, let's talk about kind of the yield curve inversion. The 10-year yield at 4% now, I have to think every time I say these numbers because we've been whipsawing around so much. So you're saying we're going to 6, maybe 7% on the Fed funds rate. The 10-year is now at 4% and not going back to the highs we saw in the fall. Have we started the process whereby the higher the Fed funds probability goes, the lower the 10-year yield might go because it's so concerned about where that growth trajectory is taking us?
One of the things to keep in mind is that the Fed is not focused on the inverted yield curve. They're focused on what it really means for the economy. If we have a slowdown in inflation, people really adapt their expectations, adapt their behavior, and we get the kind of soft landing they're hoping for, we have lower 10-year rates. But if we have a crash and a hard landing, we also get the lower 10-year rates. The Fed itself, of course, prefers that soft landing, and they're hoping that through this jawboning and early jawboning, they're going to be able to get people to change their behavior early enough so that we avoid that hard landing. But the inversion of the yield curve gives us two scenarios, and which scenario is going to be depends upon how credible the Fed statements are and how much Wall Street takes it to heart.
Probably one of the worst pieces of news, Steve, this week was the unit labor cost and productivity report, or maybe it was last week. But when it shows that for the quarter, unit labor costs, I think we're still 6.5%. Productivity is now falling. So it's now showing evidence of labor hoarding, that firms are just reluctant to let people go, which means inflation is higher for now than it otherwise would have been, and that we could end up seeing more hikes and then a deeper downturn resulting in the next, I don't know what the time frame is now, 6, 12, 18 months. I mean, this is going to be a long period of waiting for these conditions to fully set in.
Kelly, I've given up a lot of my optimism here, but one thing I've not quite given up just yet is my optimism on productivity. And we can go through that. And I think you and I probably should do a segment on this down the road. But right now, there's a lot of volatility in the productivity numbers because we had this surge of productivity at the beginning of the pandemic when some of the lower wage and lower productivity workers were let go, and now they've come back. So I'm not quite ready yet to give up the ghost. I think we've maybe had some improvements in productivity from different business processes that have come out of COVID. So I remain optimistic on that front. I don't think we're quite giving that up. What does concern me, though, is the issue of whether or not we have enough workers in the workforce. And that was discussed. And I think that we are still several million short of where we should be relative to having enough workers to do the job.
And, I thought it was interesting, Bill, he is getting asked now more about pockets of the economy where we have problems. We'll talk about this later, but commercial real estate was one of them. And just this idea of, when Warren pressed him, and he tried to say, we don't think we have to have a worsening labor market to bring inflation down. But I'm not sure that's true because it's now unit labor costs that are driving inflation higher. This is not about the supply chain anymore. This is directly an issue of the tightness there. It seems unavoidable.
Well, Kelly, you have to watch out that the unit labor cost is an aggregate number. There are some companies that are really doing quite well in keeping their costs down and changing their business models and using technology to make workers more productive. Other parts of the economy have lagged behind on that. And so you have this big spike in unit labor costs, in part because we are seeing the flip side of the huge downward drop in unit labor costs at the beginning of the recovery. But one thing you have to keep in mind is that the disinflationary forces are still in place that going all the way back to the last 10 years because technology and the changes in globalization are changing the way business models are going about doing their business.
Sure.
And I think going forward, we're going to see that we will have better profits and better results if we can keep up the pace of productivity growth. And I think Steve is absolutely right. Productivity is really the heart of what the future is going to hold for inflation.